You want to find the winner, you want to back the winner, you want to double down on the winner, you want to ride the winner.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. David, thank you so much for joining me today. Super excited to chat with you. All right, David, you are a partner at Finality Capital, and you actually lead the liquid investment fund there. Finality Capital is a multi-strategy digital asset investment firm with both venture and liquid strategies. You have a very deep crypto investing background. You were previously an investor at TradFi Digital, head of research at Grayscale, head of digital asset strategy at Fundstrat, and co-founder GP at the crypto fund Enigma Capital. All right, David, you've been in crypto for a long time, basically since like the dawn of its, I don't know, we'll call it like institutional inception in 2017 era. So what made you want to enter the space? Because I saw you had a TradFi background. So why did you decide to jump ship and enter crypto full time?
Hey, Andrew. And first off, thanks a lot for having me. That's a great question. I think like most of us, we get into it probably because someone, maybe early on was into it and they really turned us onto it and maybe couldn't stop talking about it. For me, that was one of my best friends in college. He was, mining in his dorm, and, he was, really into Bitcoin then at that time. I just missed it for maybe a year or two. And then, I had a couple jobs in traditional finance where, like many folks, back in 2012 or 13, 14, you could think, oh, I don't know much about Bitcoin. But I was, I went from an investment bank recently to PwC, and I was like valuing all kinds of weird, distressed esoteric assets. So like, there's like valuation groups that work for the banks, and the private equity funds and the hedge funds. And I would, it'd be things like, defaulted securities, debt equity across the cap stack, private, like CLOs, CDOs, stuff that caused like the financial crisis. And, I'm like, if I could figure out how this stuff works and like what it's worth and how to the valuations of it, I was like, I could figure out Bitcoin. So I did a bunch of work on Bitcoin. It was like 2015. And then, I finally invested in it. It's ironic. I bought GBTC as my first way into Bitcoin. And that there's probably some tie-in there to some time at Grayscale and other things like that. And then, I bought some Ethereum after the DAO hack around $10. I was investing in the ICO wave with some friends. And, we went on to, raise a little bit of money, and we started a small fund, a very small fund. It was like $5 million, mostly our money. And that was during the 2017-18 cycle. So one of those early waves of funds. And the fund did pretty well. Maybe our mistake was, we probably had, too much we tried to do. We also started a broker-dealer, and this was called Enigma Capital, New Advisors. We had a lot of infrastructure costs. As much as our money, we didn't raise as much as we wanted to cover everything. So, during that bear market, I went to Fundstrat. And most people know Fundstrat for a few reasons. Tom Lee is very well known. He's always on CNBC. And I went to be head of digital asset strategy for Tom. And, for those who don't know Tom's background, he used to be the head of JP Morgan's global equity research. And, it was unique because that firm, Tom had clients that were 80% of equity managed assets as the clients. So like all of Wall Street really reads Tom's research and our research at Fundstrat. And I was really the only person on Wall Street covering tokens at the time. And so it'd be interesting because during the 2020, 2021 bull market, I'd see all these big name funds and big name investors that you wouldn't think even cared. Maybe they were doing it for their PA. Maybe some were doing it and some maybe they could slip it in their mandates, but they were reading my research. And, I thought that was really awesome because, to be like the voice in the gateway for crypto for big institutions. And, from there, I decided to go to Grayscale. And most people know Grayscale for GBTC and the ETFs. I went to be head of research at Grayscale. And at Grayscale, we did a lot of interesting things. It was an interesting time, right? They were the largest digital asset manager at the time. There's a lot of stuff, around the ETF conversion that we were working on. But I also helped launch some interesting products like the Solana fund, the DeFi fund, some equity-based funds that we did. And I would write the research on them, do some research ahead of them, advise on products to launch. But eventually I wanted to get back to investing. So I went to a fund called TradFi Digital. It was a $50 million crypto fund backed by Jefferies. And, I wanted to, was doing research. We were into investing there. So it's actually back to the investing side. But I got, reconnected with a friend, Adam, who I'd known since this Medici conference. And we can talk about that later. And I'd known this since 2018, but we got reconnected and they wanted to launch a digital asset fund at his firm, Finality. And they had a venture fund. And I came over about a year and a half ago. And a year ago, I launched the liquid hedge fund at Finality.
Amazing. Awesome. Okay. So tell me about Grayscale. I know we're going back in time a little bit here, but I'm so fascinated by Grayscale and being so early with building these different products and it's still to this day has a major impact on the space. So like, tell me, I don't know, I'm just fascinated by it. So like, tell me more about your time at Grayscale and what you thought was interesting or fun or cool about being there.
Yeah. I mean, I think what was cool is that, for a lot of people like me, it's the first way to get access to the digital asset space from an investment standpoint, because it really did provide a very unique value add, which was that it was safe and secure and accessible, and it made it very easy to get exposure. And for many years that drove a lot of AUM growth. And obviously people will know a lot about the arb trades that kind of went in both directions, whether in a premium, attracting assets, or at a discount, and the whole saga with the SEC for trying to convert it to an ETF to get rid of that discount, right? Which was really the issue. Like a lot of things actually in crypto, a regulatory mismatch being a big driver. But so that was it was an interesting era. They did a lot for, I think, getting the space to where they are. It's interesting to see I think this week Barry announced, and we saw the SEC filing that they're going to be probably taking that entity public. I'm looking forward to the S1. It's definitely something that'd be interesting on our radar as a fund. And, but they've, over the years, I mean, the business has done, some transitioning, obviously, since they, launched the ETF, were able to convert. They did a lot, I think they did a lot for the industry by doing that whole process. It wasn't necessarily thanked at the time, or, maybe it was thanked at the time, but maybe not after the way they maybe wanted, but I don't know. I won't speak for them, but, they've launched new products around, the different tokens. As I mentioned, I helped with some of those while I was there. And they've continued really that endeavor. I've seen them launch several new products around different diversified single assets. So it'll be interesting to see which ones of those have demand and can generate growth. But these treasury companies too are a unique thing. They maybe are competing in some ways with the ETFs. So it's going to be interesting to see how this the convergence of TradFi and crypto plays out. And I think really Grayscale was the OG of this, the treasury company Meta we're seeing today, the OG of this convergence.
Yeah, no, definitely want to talk way more about that kind of convergence we're seeing here. But before that, so when you spoke to Adam, who is the founder of Finality, he'd been doing personal investments in crypto venture for years, and then launched Finality and as a venture vehicle, and then came to you as like, David, I want to do a liquid strategy. When he said that to you, were you thinking, okay, cool, I have a, because there's so many different types of liquid strategies you could pursue and different sub strategies you could pursue and build. So what was your thought process there? You're like, man, I have a blank slate here to build a liquid strategy. Like what do I want to, how do I want to build this specific strategy?
Yeah, well, it was great. It was really a perfect fit because, I mentioned in 2017, I had started a fund before, and I really thought this was like the perfect fit to getting back to that exact, role. And that was really what I was most passionate about and probably best suited for, over my career of having, this being the third time at a digital asset hedge fund, and having worked on really a multitude of asset classes, right? From, equities to, debt, equity, credit, crypto for many years, a lot of industry expertise, macro with Tom. And, it was a great opportunity. I'd known the team for a long time. So I knew Adam from 2018 because my partner in my first fund went to Stanford Business School with Adam. And we went to this conference that Adam put on in 2018 called Medici. And, for those who don't know about Medici, I would describe it as maybe like one of the most elite communities in the Web3 industry. It's really an institutional community that has really what I'd say is, the best allocators, the best funds, the best big projects, and the best founders. And, the way that happened really, and this is just backstory and how Finality was formed and how I got there, is, Adam's dad founded, worked with Milken in the 80s, sold Howard Marks' first high yield bond. He founded a company called Global Crossing, which was really well known during the internet era. And they had a lot of great connections. And they were able to, this is, maybe not so crazy today, but, very difficult to do back in 2018. I went to, the first Medici conference, and he was able to, get a room together of like, I'm sitting next to Fidelity, Wellington, Cambridge, and like, these are like big funds, big institutional allocators. In 2018, no one would touch this stuff, right? This, if you had to frame it again, it's like, this was just after the ICO wave. Everything was a scam. Like, you had the bubble that had just, was popping. And to get these people together, right, just to learn about digital assets, that really attracted. That's how you got the community of the best funds and the best allocators and the best, projects, because that early start and the influence of getting them together in the room. And then it's just continued over the years, right? And it's very, the conferences are very exclusive, like 150 people. So it's really the who's who, and we rotate quite a bit of guest lists, but you have access to a lot of people in Web3 from that. And Adam met Kamel, who's our other partner at the fund, and Adam and Kamel started Finality. And, because Kamel is really like a very technical quant genius. He used to be a programmer, MIT CS, built, quant trading systems, was head of quant research for a big quant fund early into crypto, and like, Bitcoin on Mt. Gox, ETH presale. And, him and Adam started investing together because Kamal was very technical. And then Adam was, very business oriented, very connected, but also very venture savvy, right, on the people side and the founder evaluation side. And he could win deals and he could help founders. And it was a great match. And that's how Finality Venture Fund 1 started. And the first venture fund, it raised $45 million. We believe it's one of the best performing, venture funds for its vintage. And, that has really performed well. And then, so when I came over to talk to Adam, I kept up with him over all the years. And this is finally getting back to your question, which is, I'd kept up with him all these years, and we had been friends all these years. I've consulted him on different moves, and I really respected his opinion. And, he wanted to launch this fund, and it was just a great opportunity to come over and launch the hedge fund. And pretty excited to be doing it over the last year.
That's awesome. And, you could have done like market neutral. You could have done, I don't know, all these different strategies. Why did you decide to go long bias? Because I mean, if I had to guess, obviously you've been in crypto forever. You're probably very bullish on crypto. So is Adam, and so is the rest of the crew there. So, instead of doing like a market neutral or some sort of very kind of more hedged, safe-ish strategy, it's like, hey, we want to grow with the market, and we want to be relatively long compared to anything else. So, I guess when you were designing the strategy, what was the thought process that went into, hey, we want to do X, Y, Z within this fund?
Yeah, it's a great question because, it's funny in digital asset space. There's obviously, it's a very, you've had a lot of growth, so there's like a lot of money to be made as a fund manager, but it's very difficult to have a long biased directional hedge fund in Web3. And the reason for that is, it's allocators, for many years, they liked venture more because you didn't take the volatility and you didn't take the marks. And, many of the funds who were long biased were really kind of pure beta. A lot of them were underperform. They would, go down 80% during the market cycles, and, it's tough to raise capital for that strategy. But, I think from our standpoint, when I was thinking about launching the fund, I was thinking that we're about to enter this era where there's the ability to be more of an actual hedge fund, like a traditional hedge fund. And, when I started my career in institutional sales and equity capital markets, I'd go on the road meet with a lot of traditional hedge fund managers, like, my first job out of college. And, I'm thinking like, this is really the era where, Web3 is maturing enough to have strategies that aren't really going to take all the downside volatility You can invest across more asset classes than just crypto. It can be crypto industry focused, right? But you can invest across all these asset classes. And the maturity, and that's really taking off now. We talk a lot more about that. And it also fit really well with our skill set. And I probably have a skill set that's focused on, fundamental research from the beginning, macro fundamental stuff from Tom. And Kamel's he has a, great macro and quant background as well. And, Adam's good with our liquid venture teams and other things like that. So, it really fit, the confluence of, what we thought the opportunity was in the market. We thought liquid was just a better place to be, given where all the capital had gone and where there's a discrepancy of capital and where we thought asset prices were. And, we thought we had unique alpha and edge across a few areas, and I'm sure we can talk about that. But, that's really some of the key things that went into it.
And what's so interesting, which is shocking to say actually, is that you guys do crypto, and traditional securities, traditional equities and other assets like that, which is rare from the conversations I've had, the folks I know. Either you're like, fully in the equity world or you're fully in the crypto world. Having this crossover is I assume going to become a lot more popular over the coming years, but you're one of the first funds I've spoken to that's doing it actively. So was that something that you wanted to do initially? Was, hey, Adam, like I want to be able to enter the TradFi world as well, or how did that evolve? And then on top of that, what was the infrastructure that's needed to set that up? Because my experience is just setting up the infrastructure for the crypto world, and so how does that work with like your fund administrator and your auditor and whatnot if they're checking kind of these two different asset types?
Yeah, I agree. I think it's more novel these days. I think a lot of funds don't do it right now because one, it's not in their mandate, and two, maybe they don't have the expertise, or three, they also just don't yet see the opportunity. When we set up the fund, obviously I was very intentional about writing our PPM or our docs to design what the fund can do, to giving us the ability to do that. And, the market wasn't fully there at the time. I think it's really starting to transition there to this kind of convergence that I've been talking about. So we did start with, obviously the portfolio mix changes over time. So we have a few strategies, right? We could be larger cap directional into some of the, the digital assets. You could be more liquid venture or fundamental into some of the smaller cap assets. And then we also have some cross asset absolute return stuff we can do. And what do I mean by that? I think one way to think about us is it's very, maybe it's unconventional on Web3, but what I think about us is there's in traditional finance, there's specialist funds for industries. You could have a biopharma specialist fund. You could have an energy specialist fund. And I think we're maybe something similar to that, right? Because like an energy specialist fund, there's a lot of similarities. Like you can invest in the spot commodity, like oil or natural gas, right? So you could be Bitcoin or Ethereum. You can invest in the futures or the options around those, right? You can invest in the companies that are developing around the ecosystem. You can invest in you can invest upstream, you can invest downstream, you can invest in the EMPs, you can invest in the small EMP companies, you can invest in the majors. But not only can you do that, you can invest across the cap stacks. You can invest in debt, convertible debt, if you want to manage risk and take different, risk views of the market. And it just gives you this fuller spectrum, which is not really novel when you think about it, because if you have an industry expertise that's very unique, and you can find the best places to allocate capital. It doesn't have to always be in the same correlated digital asset markets, right? So one thing that we try to do a lot is, like I back to this, I said the opportunity is to be a real hedge fund, right? Traditionally, there's not a lot of hedging in digital assets, and there's not a lot of uncorrelated exposures you can take, right? Your altcoin's going down with the other altcoins, right? And maybe the best thing you had a year or two ago was, crypto's going down. Maybe Maker can hold up a little better because like the RWAs are like, the rates are going higher. Maybe that was your rate hedge. Now Circle could be your rate view, right? Now you can take a credit rate view on MicroStrategy, on some of the converts, or on some of the fixed notes. You can do a lot of different things, right? You can take, you can say, I want to buy, different, I want to buy different parts of the market. Like if I want to be in Ethereum, or I want to be in a treasury company on top of it, or I want to be in Bitcoin or a treasury company, or somewhere in that cap stack. And, it just gives you this full spectrum, right? That you're uniquely suited to capture as an industry focused fund. And like, I think a misnomer perhaps is that like, oh, if you're going into the Wall Street equity, so how are you going to compete with Wall Street? I've got to tell you, these guys, because, they're obviously very smart. But when you're going against someone who manages billions of assets and 1% of their book is maybe in the digital asset space, they're just not paying that much attention. And there's a ton of alpha in that if you're doing it every day, right? Even on something like Coinbase. I remember during, I was talking to a lot of the sell side analysts that covered Coinbase right before the ETF was about to happen. And they all had like sells on Coinbase. They were bearish on the stock because, their view was, if the ETF's approved, most of Coinbase's trading volume is Bitcoin. And they say, oh, that's going to just go on exchange and they'll lose the trading volume. And I'm just thinking, no, you dummies. If the ETF's approved, Bitcoin's going up, trading's going to go up, and they're going to get all the custody fees. And I'm like, there's really actually edge to being an industry focused fund. And then there's also edge to having the flexibility to not just focus on crypto and tokens.
All right, so you mentioned these kind of three sub areas of focus: the directional large cap, the liquid venture, which is a small to mid cap, and then the absolute return. Could you take me through each one of these categories and kind of give an example of how you develop an initial investment thesis on a specific asset you want to invest in?
Yeah, I mean, I think a lot of the fund starts with directional views on the market, and my partner Kamal, he has a great background. I told you, he ran quant research for a quant fund, a multi-billion dollar quant fund. He's developed some medium-term signals that give us, risk guidance that are like, we're a discretionary fund. We're fully discretionary, but we get good data inputs that can guide our thinking on kind of macro and direction. So, one piece of, what we think is an edge is, this macro signal that we have from Kamal. And, that gives us, like a 30-day forward-looking view every month of like, how much, risk on, risk off, and we can guide our portfolio strategy. So our mix between our strategies, which have different risk profiles themselves, with that, and we can guide our overall exposure as one component of it. And then, our research that we do on the market, and a lot of research we do on just like which areas to allocate is another key component to guiding the mix of our strategies as well. And, then within the mix of the strategies, we can find great assets, we think, and we believe, and we have, done pretty well at. So, if we think about the way we will manage risk during the cycle, we try to be an all-weather fund, meaning we want to outperform really across the cycle, not at any given point, but we think across the cycle. And that's, by a few things. That's by managing drawdowns. That's by having the right risk exposure and the right risk, taking the right risk rewards, and obviously picking the right assets. And, so like across the cycle, maybe in the early cycle, you want to be more in the direction of large cap focus. Maybe, before the election, we put on more liquid venture positions because we thought those were outperforming, give higher beta. Somewhere like January, and, February, we went to a lot of cash actually in December and January, right? We managed risk down. In February, March, we went to a lot of our absolute return strategies, which can be, more downside protective, safer, but can still give upside too. April, May, we went out back into directional, more longer bias stuff. We've really been riding that, since. And, we're shifting maybe a little back now to more absolute return, more cross asset. We've done several, investments and deals in some of these treasury companies recently. Some that have turned out well, very well. And, we continue to look at that space, and we're evaluating the market as it evolves.
Very cool. All right. So take me through the liquid small cap, the liquid venture, small cap, mid caps. Are you, because you have this kind of broader view in the market with these signals. Hey, is the market broadly going to be bullish or bearish during this time? You have the basic kind of view there. But if you're looking at a small to mid cap, is it based on, hey, this, Aave is generating X in revenue and growing at Y, and is it more fundamentals based, or how are you assessing which mid or small cap to enter?
Yeah, and I think, and even backing up, right? Like I think within the risk parameters, right? It is all fundamentals based. So, whether whether we decide, fundamentally we want to be in, Bitcoin or ETH because there's, now because there's more treasury company flows. And so I take this full ecosystem view, right? There's treasury company flows, which were the thing that, was driving a lot of MicroStrategy, drove a lot of Bitcoin's outperformance. You're seeing that now with ETH, which is less liquid, even though those are smaller, but it's growing fast. So we've shifted, shifting the mix, even on the large caps, and then also in the way we want to take exposure, from our directional view, right, across all of it, we will, say, how do we want to, get this exposure again? And that's fundamental as well. And how we shift across all of it, right? So, if it's back to the small caps though, yes, it's definitely a fundamental underwriting process, but we'll also really, we want to own things for a medium time horizon, several months, but also we're not afraid to really manage risk because, one thing that's been key for us is we haven't drawn down a lot, and much less than other funds because we're not afraid to really cut those positions if the market's going to fall apart, which we did really in December and January. And, that helps a lot, being able to cut the positions to manage risk. But in terms of the owning of them, when you're not, managing risk around these different broader cycle moves, it really is fundamental. It's thesis driven, it's bottoms up, talking to the founders, modeling out economics and thinking about where the opportunities are.
And when you say fundamentals, it's funny because crypto is a unusual world where revenue for a lot of these protocols is relatively new. I mean, relatively as in past couple of years. And there's things that perform well, but you could argue the fundamentals are pretty terrible. Not to name names, but XRP, is performing really well, has been for years. And you could argue the cash generating fundamentals of XRP is not great, right? So when you see fundamentals, what are the factors or the traits that you guys are diving into and considering these metrics equal quality, or these metrics equal, hey, maybe it's not quality like an XRP, from a revenue standpoint, but the narrative is so strong and the number of holders keeps increasing. Therefore, that is a quality indicator for us.
Yeah, I mean, when we make the liquid token investments, there's a couple things. We do have a thesis around that extends from the venture fund. I'll talk about the thesis, and then I'll talk about kind of the fundamentals, and then I'll also talk about views on things like XRP. But the thesis of the venture fund, and Kamal developed the thesis, which was that you're going to have the reason there's not a lot of great apps in Web3 is because you don't have enough middleware, and you need the middleware for the great apps, and that needed restaking. So they were really big into eigenlayer, and then they invested in a lot of the middleware on top of it, like a key piece being something called opacity, which is like Plaid for Web2 data. And you could put any Web2 data on chain, and that means that, for example, apps, there's an app on top of it called Earnify that I've used before, where I've connected my bank account, my Gusto, and I've gotten a payday loan, from an on-chain DeFi protocol, because you can verify that the data came from JP Morgan server and it wasn't tampered with from the time that it went on chain. The same thing with my payroll data. And you couldn't do that before with Chainlink because, it's private data. You have to be able to verify it and you have to trust the source of it. Right. And, Eigenlayer enabled that, Opacity is enabling that. And then now you have all these consumer apps. So, that we're investing in on the venture side. So this is the venture fund. And, so there's a thesis there around how it's going to evolve. So we try to, if we have edge, which in those areas, we'll try to invest in those, but the market, you do have to look for where the opportunities are broadly as well on the liquid side. So, we'll look for things with, we think about it like investing in just businesses, digital businesses. It's growth investing and in this component of the book. And, we think about it probably in a similar way to an equity view on underwriting an asset, a very fundamental equity view, which is, you want to buy something with product market fit. We have a podcast actually, and we interview founders from through Medici. And we've had a lot of great founders on. We've had on, for example, we had Mike from GeoNet. We bring on a fund with them as well. So we brought Seth Gens, Coin Fund. We had Tushar come on from Multicoin with Jito, Lucas. We've had Michael Arrington come on with Robbie from IMX. We've had Babylon David Say come on with Ted Breyer for Bar Capital. We had Maple come on with their research. We've had Pendle TN come on with L1D. We just had Arrow come on. So we have a lot of great founders. And the reason I bring this up is, the lens of the choice we look at it kind of goes through in this podcast like a diligence view of how we think about the tokens. And it's, what's the thesis? Like, how does the product work? What's the opportunity within the product? What are the adoption metrics? Like, how, what are the key things to focus on for growth, tangible? And then how do you think about, obviously the economics and the valuation, right? Does it make money, and how? Or can it make money in the future, and how? Right. And then how do you think about, the competition relative to it, both from a valuation, but from a competitive standpoint? And then how do you think about like the economics of both the supply of the token? How does that flow back to the value capture, right? And the valuation as well. But importantly, you also have to think about, what are the catalysts, and, even more important, perhaps maybe the risks. And, so that's really the way we kind of, as a high level framework, kind of work through like, an evaluation on some of those assets. And I think, when it comes to other things like, XRP, for example, I've been in the industry long enough to not be idealistic. I think the thing that makes it great is it has a great community. And, like there can be meme stocks, Palantir, maybe people say Hood is a meme stock. I don't know. But, you've seen periods. Ripple is not unusual. It seems unusual, and it seems to defy logic, but it really doesn't. They have a really vested community that treats them as, it's a zeitgeist, like with Bitcoin or these others. And, the fundamentals of Ripple, maybe they're, not there on chain the way people think. Maybe it's not the fastest chain or the best tech chain, or maybe the most used even. But what they can do, what they're doing really, is something that's really happened many times in traditional markets, which is you have a company that perhaps its stock becomes overvalued for whatever reason, right? Back to this, meme coins in the traditional realm, but you have an acquisition currency. That acquisition currency is your equity or your token in this case. And you can use that to go really reinvent the business. And it does seem like, Ripple is a protocol right now that's going through that reinvention. They've, been acquiring different business lines, right? Once you have a war chest, you can do these things, and it gives you a lot of optionality, right? They acquired, Hidden Road. They've done the stablecoin thing. It'll be interesting to see what they do next. But when you have that much, you have that dedicated community, the zeitgeist, you can get the war chests. You can really have optionality for actually doing something that could be a meaningful business. And, so it'll be interesting to see how it evolves, and if they can really find those fundamentals that can really back into the justification of the price. But that's how I kind of would think about something like Ripple within this market.
Yeah, no, it's interesting because, a lot of folks point to crypto being like, oh, Ripple, like XRP doesn't have any fundamentals. Then you mentioned like Palantir, which, sure, it's a real company, real revenue and whatnot, but it's like the valuation makes like no sense currently. And then you have AMC and like the actual meme stocks, right? So it's like you're talking about this behavior of these tokens not tracking any sort of fundamental quote unquote valuation. That's been a behavior in crypto and out of crypto like for a long time. So it's not just a crypto specific thing. So that makes total sense. So what do you think about when you are speaking to these teams? Because you mentioned you bring a lot of teams in the Medici pod, and you've been talking to a lot of them. What is the ideal? Okay, so if you could force all the teams to create some standardized format of documents or podcasts or some sort of information that gives you just the pure juice of whether or not this is a great investment or not. Because I'm sure a lot of the times you talk to these teams, they're talking about tech, but you're like, well, I'm a liquid fund. I already understand the tech's great. I need to know how this token is going to accrue value to my firm. So is there some sort of like magic, not even magic, just like standardized reporting that could happen that you would love to see from teams everywhere? Or maybe just some like simple IR process that they would all follow in order to make liquid crypto investing easier?
It's a great question. I think it's happening already. And, for example, you're seeing like Blockworks recently had their disclosure framework that they've put out. I think that's a good first step. I've seen other people go through different disclosure frameworks around wanting to do valuation. I think ARC is working on something like that. And I think it's happening. And the other piece you're seeing is projects get more organized like traditional companies in the way they discuss and go to the market and talk to investors. So, you are seeing projects have almost IR-like calls and quarterly IR-like updates to investors. It's slow. It's a process that's evolving. It's not going to be a fit for every protocol, but I do think it's happening. It's going to happen more. I think you need more to happen. The next leg of this that I would like to see, and it'll probably get forced by regulation like market structure bill, et cetera, is probably stuff around, supply dynamics, insider ownership, insider sales, liquidity, investing of the token, and then just disclosures around that are just important disclosures that you should have that make it not feel like it's, this is the problem that we've gotten into today with crypto, right? Many of the liquid tokens don't trade well because a lot of the market, especially retail and even more and more liquid funds, they feel like it's a game that's, you have the VCs cashing out against you, and we all know this. You have the teams cashing out sometimes against you and buying houses. You have and there's some perception that the market makers too are, cashing out against you or something like that. And it feels like for some, there's a sentiment around this which makes it difficult to get, money into some of these tokens because of this. It feels like, there's people are launching the tokens before there's value accrual and product market fit, before it's product market fit, without the value accrual, and then at the inflated valuations that are designed to cash other people out, and sometimes to cash them out even before they launch, right? When they're locked, right? You could sell. There's a lot of ways to sell when you're locked. So, I think like the right disclosure regime in Web3, obviously beyond, building product market fit, these things are all important, right? You have to do something that's useful. We think that's going to happen with some of the stuff. We think there's going to be an explosion, right? With the stuff I talked about on the venture side of real world use cases in consumer apps of tokens that are going to come out and actually find product market fit and get usage. And it's going to be like the next era. Like there's three eras, right? There's currencies, we believe, Bitcoin, stable coins, and there's finance, DeFi. We think this current consumer era is going to be the next era from these things. So you're going to see product market fit. But on top of that, after product market fit, you need the economics and the monetization. So it's got to make money like a business. And then finally, I think you need to have the trust to deserve multiples, right? Because if you want to deserve a valuation multiple that factors in some future outcome, you have to also feel like the teams are vested in the projects for the long term and they can continue to generate compounding returns, right? One reason you see there's a big push today to do buybacks, right? There was a whole bunch of buyback pushes, right? I proposed for Jito the smart buyback solution, which was the buying back at different valuations, because people were trying to say, we don't want to do buybacks, buy the token at the wrong price. But there's a big push for people to say, return capital if you're making money, right? Back to holders, because they find that tangible value useful because they don't really know if I give it to you, I put it in a DAO, how is it going to get siphoned? How's it going to really get reinvested? What's the growth? And, and then also like, just again, back to the stuff with the supply, are the teams cashing out before they found product market? Are they going to continue to grow it, reinvest it, and growing it for years? So I think that's like the next evolution of what the market needs for, transparency and governance. So it's, the next thing is in here, use cases and product market fit, economic value capture, and then governance, right? That's transparent. It's ironic because we're on a blockchain, but, there is, off-chain stuff that matters that needs to be brought on-chain, transparency to get the market, functioning properly to make money again in these liquid markets. And we think it'll happen. It's just going through a transition phase right now.
Yeah. Okay. So when you are, so you said that middle step was You said first it was product market fit, then economics. Have you run into many products or companies or protocols out there that have a great product, great usage, et cetera, but the token economics are all screwed up and they just don't send any value accrual, or there's no value accrual mechanism back to the actual token or holders? Is that something you run into often, or is a protocol that has product market fit, do they generally have their tokenomics in general order?
Well, I think the first thing to go to is, the evolution of how much it's mattered. Historically, for, 2017, 18, 19, it really hadn't mattered. Maybe in, 2020, with DeFi and the adoption of revenues and fees and onward, it's incrementally continued to matter more. And I think it matters more, more today, to where you're seeing that the fundamental tokens are outperforming the broader altcoins, right? Whether it's, Hype or Maple or Aave. So you're seeing it matter more and more, and the market be more disciplined about demanding that. And, I think that, yes, there's a lot of examples where, it's a great, interesting, novel use case, but it doesn't charge any fees, and the market will punish them for that these days. But also the other issue you can have is, even if it's making money, the supply side economics are not strong enough. It might not perform well either, because, it's like a company giving too much stock options and having inside employees selling, even though they're making money, and, you're giving stock comp and they're selling. It's, the supply dynamics might not go up. Right. And that's, it shouldn't be thought of as an expense, right? On the vesting and the unlocks, but frequently it really is. There's no value capture. I mean, the biggest problems are after product market fit and usage. Are you charging any money for it? Or are you giving it away for free? Right. And that can work, right? If you're trying to be Amazon for a while and, low margin, you want to grow. But I think the market's going to punish that for a while still. So you're charging anything for it to prove that anyone is actually using it, or if it's just spoofed. And then two, when you charge something, does it actually flow back in a way that connects that value to the protocol, or do you just like recycle it and pay it out, and like it doesn't connect any value inherently to the token itself? Or the other thing you see too is like, Uniswap, are you siphoning it, right, to some other entity, which is, maybe one reason it's performed more poorly than something like Aave, right? Even though both you can consider the DeFi blue chips of prior cycle on Ethereum, right? But it's, they haven't turned on fee switch. They've siphoned the value to the labs and Cs. So these are the other things that matter. And then finally, even if you are returning value and you are buying something back, is it enough to be meaningful relative to the amount of supply that wants to come into the market for other reasons, right? I think the reason the market likes something like Hype so much is because it's buying back so much in supply. And, they have a big unlock, I think, that's coming. So we'll see how the market reacts after that supply unlock, because their dynamics are changing a little bit with, I said that they have, like Hype is a good example. They have the things that we discussed. They have product market fit. They have value accrual, or they have product market fit. They have fees and economics. They have value accrual. And now, maybe they're going to enter a phase where the market has to decide, and we're going to find out if the supply side economics on that final piece will still continue to work in its favor. And, I'm not telling you that there's an answer, but I'm saying it's going to be an interesting case for that project to see how that works out.
When you're looking for new token investments, what type of platforms or products are you guys utilizing? Because, there's Blockworks Research, there's Kaido, there's the Tide, there's all these different amazing tools out there. Are you surfacing new opportunities from these platforms, or like DeFi Llama or whatever? Are you surfacing new opportunities from, oh, hey, there's a token here that's now generating lots of revenue, we should dig in? And so number one, like, how are you sourcing or surfacing these new opportunities? Number two, when you're like, okay, this is interesting, we want to dig deeper here, is your diligence process like, hey, let's do a whole bunch of research and then jump on a call with the team? Or do you go to the team right away, like, let's just see if they're even like, good people and like, docs and whatnot? Or like take me through your general flow of finding an investment to eventually making the actual investment.
Well, on my side, I do a lot of it. I mostly run the liquid fund myself and do a lot of the research. I found for me the way to be good at sourcing ideas is to talk to a lot of smart people. And I've been doing it a while, so I mostly just try to have monthly calls with all the other funds, some of the sell side guys, some of the great research analysts, and I just try to be in the conversation flow to get what people care about and get some consensus on, what's interesting, right? And consensus doesn't mean you want to invest in it, right? Because sometimes you want to go against the crowd, but sometimes the crowd is right. So you have to evaluate that and do some more work. But you can get a look and get the rationale from a lot of people on the things that are emerging and interesting. So for me, a big part of my process, just as a way to scale, is to leverage the network. Because I don't have the time I have to manage the fund, operate the fund, to go in the weeds, down the market caps, and just kind of look at every new thing, right? That's my filtering mechanism. More and more these days as we're investing more and more in traditional stuff, I'm starting to use some sell side research from some of the regular banks and looking at different, what they think about some of the different companies or different vehicles that are out there. So on that side as well. But, on the data side, I've been doing this a while. We don't currently use any data providers that we pay for, but I can tell you who I like and who I think is really good. I think that the ties actually, I think they're great. It's a great platform, but it's a lot for us at our size. At some point, they actually have a conference I'm going to be speaking at next week, so
We'll see you there.
Oh, great! It'll be fun. Out east in the Hamptons, so I'm looking forward to that. And Josh is great. He built a great product, great team over the years. Every time I've demoed it, I've been impressed with how much they've managed to really grow the feature set. So I think we're probably growing into a place where we're getting close to being ready for something like that. They really are like the Bloomberg for crypto. I think Artemis does a good job as well. There's probably others, but we do like some of those different firms and think they're kind of above. More and more these days, I kind of want access to a traditional Bloomberg, given, a lot of our focus really has gone cross asset. Most of the stuff we have right now in the book is almost actually less tokens and more equity, and some convertible debt. So equity related and fixed income. So there's, I might, get to a point where I would prefer that as well. So, that's kind of the way we think about it. Oh, and Blockworks Research puts out great stuff. We don't subscribe, but I talk to the people in the team there, and that's how I kind of get, different insights and alpha. I think that they have great dashboards. The public ones are great. I think I have a lot of respect for that as well.
So when you come to, when you kind of identify something that you want to dig deeper into, are you looking at first the fundamentals of the actual project? Because let's say you've talked to 10 other managers and they're all really jazzed on XYZ token or whatever. So XYZ token, are you then diving into all the on-chain analytics and all the data and all the wallet information, the trade data and whatnot, and then deciding, okay, this is actually really promising, we want to talk to the team, or do you need to talk to the team, or like how is that general flow work?
Yeah, that's a great follow-up on it. Look, we definitely try to go deep on it and understand what we're owning. I think that we want to look at the fundamentals, like I said, and the evaluation, and then we eventually do want to talk to the team. And, you can see how we think about those sometime in the real time on the podcast that I mentioned, and talking about the team. And it's a very, traditional thing to do in, finance. I'd take, when I was early in my career, I was a 22-year-old, I got to take the CFO of a company called Seagate. They make all the hard drives in the world, to see like TCW and meet the entire portfolio team, and like listen in those meetings, the back and forth and how they think about it. Obviously there's different things that matter in crypto and Web3 for the evaluation, but just that face-to-face process of really understanding a business or a protocol and the opportunity there is useful for anyone, and it builds great comfort. But you don't want to be overly comfortable, right? You have to ask the right questions, but and it's great to have those relationships. Medici gives us access to really almost any founder we want. Like we could talk to almost any founder I want, and I don't think that's something most people could do. And maybe if you're Galaxy, you could do that, or a big crypto fund. But most people can't just get, even especially funds at our size, can't just talk to any team they want. And So that's maybe one, thing that we think is a big value add.
Very cool. All right. So I want to talk about the portfolio construction. How concentrated, because I know you have like, I guess, 3 different sub strategies or sub kind of areas, which is the directional large cap, the liquid venture small mid, and then the absolute return. So within each one of these kind of sub strategies, are you very, very diversified? Is your portfolio, do you have a number of different names in there, or is it highly concentrated with 3? Or how do you break down that portfolio concentration?
Yeah, generally we try to have 10 to 20 names. We try to understand the stuff we own,
And sorry, this is 10 to 20 across.
the entire portfolio. And, the mix of where they are could shift over time. And, we try to not have a bunch of small names that we don't understand and trade in and out of a lot. And most of the book is generally, in things we understand, but we'll put more risk into some of the larger stuff, the larger cap directional. You can be larger and more risk into that. And the structure you want to get that through, you can vary, whether that's through a treasury company for Bitcoin, whether I want to own MicroStrategy or Bitcoin or one of the new ones, or Solana or DeFi Dev Corp or Ethereum or Bit9. And then, on the liquid venture stuff, takes time for thesis to play out. So we're still fairly concentrated there, maybe 5 names sometimes. We don't have that many right now, just given our view on the market is currently less optimistic on tokens relative to the equities. But, we try to be concentrated there when we do take the positions. Obviously, they're less liquid, so sizing has to be smaller. And, but again, we're not trading in and out. We're coming in T-WAPing over time to get in and out and doing it for a medium-term time horizon with a thesis and a view on the underwriting. And, similar for the absolute return stuff. So, maybe 5, sometimes 5 names in each category, but, you could take those, the shift mix could be, 10 to 20, and you could have more or less in any bucket at any given time, depending on our broader market view.
And when you're deciding, or how do you decide when to exit? Because crypto, again, is an unusual beast here where, the upside could be massive, but also there's massive downside, risk there. But, do you have a framework for how and when to exit positions?
Well, a lot of it, the primary driver is going to be macro. But 2, obviously there's idiosyncratic views for each protocol, whether the thesis has performed out and they've reached some target or some reasonable valuation, or some perhaps it's just concentration and positioning, right? Sometimes these names get crowded. Sometimes the thesis doesn't play out and you have to exit because the thesis doesn't play out. Sometimes you have to exit just to manage sizing and risk. You don't want to really, cut your winners too much, but you do need to manage risk, but on the cutting your winners, Stan Druckenmiller has something he said once that really stuck with me. It's like, you want to find the winner, you want to back the winner, you want to double down on the winner, you want to ride the winner. And, and that's how he made a lot of his money. So, we will try, if we have something that's just a clear winner, we will want to, ride it. But, the factors that really come into play for exiting are, macro, the thesis, the valuation target, the reasonability of that, the positioning, and then, just thinking about any other catalyst or risks that might materialize around it, whether that's supply shocks or different regulatory factors or whatever it could be.
Yeah, I think, one of your huge sources. Oh, sorry.
Maybe I'll have one final thing, Andrew. And it's also just, where is the best place to put capital? If there's just a better risk reward somewhere else, we'll shift it around, right? Like if we want to just shift our risk reward profile, like there's obviously opportunity costs in the portfolio. And, also something we're doing more and more these days is looking to technicals as well a bit. It's not the primary gauge, but it's becoming more and more of an important factor.
Interesting. Okay, so I think one of your guys' huge source of alpha is the being a part of the Medici network. I think you're a partner there, or you're a part of it somehow. Adam's the founder of it. So, like, tell me, like, what is the Medici network, and why is it valuable to you guys as a firm?
All right. So I mentioned Medici was, really this elite community, and of most, the key builders, the key companies, the key protocols, the key allocators. I think it gives us a few things. It gives us the ability to both get our ideas in front of other investors. It gives us the ability to source ideas from great investors. And as I mentioned before, it also gives us great access, both to, the investment opportunities themselves, like the founders to diligence things, but to get into deals if I need to get into something, or I need to talk to an expert in another area to evaluate something. So it's really, those are some of the key components about it.
That's awesome. Very cool. And I think that Adam is a part of the, what is it, the DCA, the Decentralized Cloud Alliance. Isn't that also, I would imagine that's also a pretty big source of edge for you guys as well, because he has all those contacts within that kind of deep in more infra world.
Yeah, that's really a nonprofit that we started. And to be clear, Medici is separate from Finality, right? We are, Adam calls it a open protocol, and we're an app on top of it, and we leverage that app just like other people leverage the app. But because we've invested a lot in it, we have, we're very close to it, and we're like maybe like like the biggest app. Maybe we're a big app transactor on it because we like to use it. We want to contribute to it ourselves. And DCA is similar to something we founded, and it's a group of, we call it, the cloud, different, the Decentralized Cloud Alliance is really like this cloud application stack. Like EigenLayer has, they developed this Eigen Cloud concept. There's people doing it across other ecosystems, Babylon, Jito, there's apps on top of it, there's restaking, there's just different builders and teams. So that gives us access to novel tech, if we want to diligence novel tech. And that's something that we think about as well.
Very cool. Okay. So do you think about do you have a lot of assets on, because I'm thinking of risk management, you guys hedge, you guys kind of, you guys are defensive when macro conditions start to deteriorate. Do you guys have to consider the liquidity risks with the different tokens that you're investing in, or the exchange risks? Like, do you guys have lots of assets on exchanges where you're like, man, we have 10% on whatever exchange, like if this goes under, then we're kind of screwed here. Like, what are some other risk factors that you guys are looking at and kind of paying very close attention to?
Yeah, I mean, we're very liquid. We're very liquid relative to most other funds. We don't do, treasury deals that are locked, or into these OTC deals or anything like that, or invest in other funds or invest in private companies or anything like that. We have done what we have done is a couple of the treasury deals that are very short time to market and are very highly liquid for us, within several weeks to a month of liquidity time horizon. That's just like a hedge fund investing in, about to invest in an IPO that's being registered, for example. So it fits within your liquidity constraints. So we're very focused on liquidity. And, again, back to liquidity on the small caps. That's one reason we keep sizing smaller. That's one reason we have less allocation there at certain points in the market cycle, just given they're less liquid, harder to get out of. So that's definitely a key risk. But, the other thing we focus on is counterparties and exposure. Primarily, I mean, we trade, our digital assets with Coinbase, and also with, Kraken some. And, our traditional side, we trade at JP Morgan, we bank there, for our traditional, securities and, assets. So we feel good about, both of those counterparties. And we try to diversify the risk as well, where we can. So, we're also starting to custody at Anchorage, so we can split that up a little bit. But, I think counterparty risk is the thing that's important to focus on. It's impossible to get rid of in Web3 at this point, but we feel good with the counterparties we have.
In terms of and this is a kind of a question for me, I'm always curious, what are the operational headaches that you have the most, that you feel the most when it comes to operating the fund? Because I know when we first launched our long short crypto fund, our fund administrator at the time was like, it was just brutal. Like the reports were so late, they were always messed up. We had to go back and fix them, and it was terrible. So, and it's light years ahead of where we were back then, of course, and kind of the whole operational stack is light years ahead. But today, if you could point to what is the biggest operational headache that you experience in terms of whether it be like fund admin or custody or audit or whatever, what would that thing be?
I think it's the fragmentation of the counterparties, because it's not like you have a prime where you can do everything, you can finance everything, you can have your custody and collateral there across everything. I think that that's maybe the biggest one.
Yeah, just having like 50 different accounts on 50 different things to do whatever specific function instead of it being aggregated at one point.
And yeah, I mean, especially also now that I'm going cross asset, right? It's not like I can collateralize a margin, we don't go net long or short, but it's not like I collateralize any position with the margin from my Coinbase versus my JP Morgan accounts. So, it's the worlds need to connect, and maybe that happens somehow with, tokenized stocks, or then, these crypto exchanges becoming banks themselves, or with the reduced regulation or the, I guess, encouragement from regulators so that the traditional institutions can engage in these activities. So that's probably how that merges. But today, that fragmentation is still a pain point.
All right, so give me your grand vision for Finality. Like if if everything goes right over the next 5, 10, whatever years, what does that grand vision look like for you?
Well, Finality, I'll leave the full Finality vision to maybe Adam Kamel, but I'll focus on the hedge fund, which is what I spend, the liquid hedge fund, which I spend most of my time on and run. I think for us, I think it is growing into being a very, obviously a large traditional like all-weather fund, similar to what you see in the, many other parts of the traditional market, but within this digital asset sector. And I think that means, maybe it could be other funds and strategies that could be sub-strategies of what we have. But really the flagship I want to focus on is just kind of the pure alpha that we can generate here within this fund. And, I want to do, more, as more companies come to the market, whether it's Grayscale or Gemini or Kraken, or, obviously if it's the right deal, it's got to be the right investment. But I'm just, naming some, for example, right? I want to do more in that space. I want to have the ability to run it more like a regular hedge fund and have more diversification, in the book, whether it's more credit, to transition more of the levers. But at the end of the day, also, I mean, we're a hedge fund. We want to make money for our investors. And that's really the primary thing we want to do. And we want to, let them sleep at night by not having too much risk and managing the volatility better than everyone else. And we want to really outperform global asset classes, because we go multi-strategy here. And that doesn't mean just Bitcoin, right? We want to be able to make money in down cycles too and protect as well. So that's what gets us excited.
Very cool. Yeah. So, I want to talk about this convergence of DeFi, of TradFi and crypto. Like, are we going to, in 5 years from now, is there going to be a strong distinction, or is it all going to be, most equities will, not most equities, but some equities will trade on chain and that'll be kind of normal. Some crypto tokens will trade just like stocks and kind of be more cash flow based and, revenue based. Like, what do you see? How do you see this convergence of TradFi and crypto, and where do you see the market headed?
I think you really started with some of the great key points, which is, you're seeing crypto make its way into TradFi with the Treasury companies, the ETFs, and you're seeing TradFi make its way on chain, tokenization. Paul Atkins, I think, said something the other day, that you can tokenize a lot of these securities. Obviously, Pierce has said, and this is obvious, you have to obviously abide by the rules just because it's tokenized. And, I think the thing that's going to allow it to converge more is at the custody point, because of the mandates. If you're a traditional fund, maybe you can't custody unless it's qualified custodian, which is, most of, Coinbase is through a trust charter and the state trust, but, sometimes these federal trust charters, and there's different questions around that. So as banks can custody, tokens, maybe it doesn't become so novel for a big hedge fund to be able to invest in structure. But there's also limitations, right? With, you have to see some of these, some of these funds will have an equity mandate, or they'll say I can do equities or commodities, but I won't say this token. So there's going to have to be there's always it takes some time, even if the infrastructure is ready. For the regulatory is there. First, if the regulatory is there, the infrastructure is ready. There's still time in the adoption, and just like any adoption curve, like we've seen with crypto over the years, I think it'll happen. But I'm not sure, how fast it will be, but in these unique pockets, there's definitely explosive growth.
Yeah, how do you feel about these crypto IPOs in treasury vehicles? Because I feel like the public markets are so starved for just like action and IPOs and kind of new blood, so to speak, and also like innovation. And I think crypto companies like want to go public. They want to get out there, be institutional and whatnot. But also they represent this massive, innovation layer and this new change. So I'm hoping, and what we're seeing is that there is excitement. Hopefully it continues. But I guess, yeah, how do you feel about these crypto IPOs of these traditional companies, Kraken, Coinbase, whatever, et cetera, Circle, and then also these treasury vehicles?
Well, I used to work for Tom Lee, and he said a lot of things that stuck with me that are insightful. One of them that's really relevant here is he said, David, we're so early because the banks haven't even gotten behind it. And once they get behind it with the sales machines, they can make money off of it. They can finance it. They can do the banking deals. They can turn their sales and research on. You're going to see a lot more capital flow in. And I think that's like the stage we're at. And, it's manifesting, with Circle, right? One, to start this kind of IPO window, of course, but, and that's, obviously a great proxy for funds on the stablecoin play. But, the treasury companies really are the explosive banking fee generating meta for Wall Street right now. And, it's interesting though, because now you have, Wall Street analysts, because they took in 2 or 3 Solana treasury companies public or Ethereum treasury companies, they're going to be covering the tokens, right? They're not just going to be covering Coinbase stock and saying, we don't have a view on Bitcoin or whatever, right? They're covering the tokens and they're covering the sector. And I think that's, and obviously the capital that flows in, or whether it's something that goes to DeFi Dev Corp, that capital can flow in and it can get invested in the on-chain economy. So, like they could launch Web3 businesses like DeFi Dev Corp. In some ways, they have an LST, right? They're a Solana treasury company like MicroStrategy, but they have an LST, right? So, did Aave need to, or I'm sorry, did Lido need to be a DAO to have an LST, or could they just be a company like DeFi Dev Corp and accrue that value back to an equity entity? So I think you're going to see a questioning for these governance reasons I talked about before. And also because, I think a lot of money was funneled to tokens because you didn't have the outlet in the traditional form for regulatory reasons, right? If you didn't have that outlet to capture the crypto exposure before in traditional forms, you went to tokens, right? It's de facto way you could get around it. Now you don't have to go around that way. So there's going to be a lot of, I think, re-examination as to what really needs to be a DAO governed organization. And there are things that we'll want to be, right? We think that token incentives are going to be useful, right? We think that's going to be really useful for bootstrapping still supply and users. But, there's going to be a lot of stuff that really questions whether they need that product market fit or can be in a traditional entity. And I think that the ability for, banks to take these companies public is going to really drive a lot of capital that ends up back in the ecosystem, right? Like these treasury companies are borrowing on Aave, or Maple's going to finance some of them. And so I think that's like the longer term kind of meta that's playing out. And, some of these are becoming ecosystem, like they're becoming like the sovereign ecosystem funds, right? If you have a sovereign wealth fund for an economy, right, they're becoming the sovereign ecosystem funds for these economies, right? And I don't mean like the ecosystem funds that were pervasive in 2017, where the company put, maybe it is somewhat similar, right? In 2017, there's this whole era, I have XYZ01 and I'm going to give my treasury tokens to this ecosystem fund and we'll call it a big raise. And, say we raised a bunch of money for the ecosystem, where they really just transferred the value and marked it. But, I think that'll be good over the long term. I think that there's a lot of concern. Well, first, there's a lot of skepticism, one, about whether these things are sustainable. And, I've lived through the GBTC arb trade on both sides of it. And there's some similarities or some differences, right? Like there's a premium. It fluctuates for market reasons. And, but there's different mechanisms, right? In terms of, they couldn't buy back shares. These companies can do different things with their capital structure to bring valuations back in line. If you go to discounts, they can grow the assets per share of the native, which you would be stuck with a static asset per share, slightly depleting these days given the fees. So there's advantages to some of these structures. And I mean, the premiums they can trade at really are going to depend on the ability to grow that asset per share, per diluted share over time for whores. And like we invested in Bitmine Immersive Technologies, which is their treasury company. And we put a sizable position there. And, they've just raised $250 million. And, the other day, just yesterday, they announced that they now have, they have $1 billion of ETH. So in a couple of weeks, I guess it's 3 weeks since we've invested, they've grown their balance sheet from 250 to $1 billion of ETH because they were able to sell their equity, right? As invested before it's unlocking, there's a lot of demand, and they've grown the ETH per share by, maybe it's 3 times or something like that, 3-4 times, right? I don't know what the exact dilution number will be that they've had to pay for it, but the ability, the ones that can do that sustainably, that have good management teams, that can get, be market leaders, can build the right liquidity around the assets, and can tap debt markets at lower costs of capital, right? So you can be like Sailor and you can sell or convert at, a price that creates, whether it's ETH or Bitcoin per share growth, because your convert investor wants to have a safer place to park their money, but some exposure, right? And they're willing to give up part of that growth. There's different ways to use the capital structure to create that per share growth. And in the sustainability of it really is like a bank, because a bank, I don't want to say exactly, right? But this is a good analogy, I do believe. A bank, I'm a depositor. I put my money in short term. I'm senior in the cap structure. I take less risk and they lend longer duration. They collect a net interest margin. And, it's the question really is for these treasury companies, how sustainable these premiums are is, can the management teams collect this, net interest margin, and how much and for how long? And then that's going to determine, what they should trade at over time.
Very cool. David, this has been amazing. It's time for the closing questions. All right. You have to hold one crypto for 3 years, and it cannot be Bitcoin, Ethereum, or Solana. What would you hold?
Oh, this is tough. It's kind of down and out, but I might hold Babylon.
Babylon. Wow. Very cool. I like that. Tell me more.
Well, it's staking for Bitcoin. So people think about it like reef staking or L2. I mean, really, it's like the beacon chain layer on top of Bitcoin. And it lets you do it trustlessly, non-custodially, and verified by the L1, the consensus rules that exist for the traditional code. And then you could stake and you can earn fees by securing other chains. So if you want to bridge and secure other chains, it's the best tech, I think, for doing that. And, as a liquid venture position, right, it depends on how much mark you want to take. Some of these, it needs to go through its phase of getting product market, like getting the adoption, because they're early in rolling out. But tech's the best. The team's very high caliber. And, I think they're going to get product market fit and get other chains that want to tap into Bitcoin's liquidity and on top of Bitcoin with security and people that will want to stake, especially as the trust plays out. Like turning Bitcoin, making it stakeable on chain, seems like there's value there. And then it's just a question of like, if you think about the piece, like the layers, like how much value will accrue to the layer that's right on top of Bitcoin that has all this other stuff goes on top of it. Like if the beacon chain was its own layer, how much value would accrue to the beacon chain?
Very cool. I love that. All right. What is an overhyped and underhyped trend that you're seeing?
It's funny. I think it's the treasury companies on both sides.
Really?
Because it's overhyped. The deal quality, I've looked at a lot. The deal quality has gone down a lot. But within them, there's still some structures that makes it. It depends on like the team, the execution, and the structures. But a lot of it's overhyped right now.
But simultaneously, you think it's underhyped.
Yeah. So if you can find the right ones and the right structures, it's underhyped as well because, and you can use them the right way. But I think people that are just going in, there's a lot of people who are very thoughtlessly going in thinking, I'm going to put $1 in and I'm going to get 2. I think they're going to be very wrong. And then I think if you're smart about what you own and like the type of security, again, you can buy different securities in the capital structure. We just did a deal for one where we bought a senior note of one of these Bitcoin treasury companies, very big, but it's like 3 times over collateralized. We're not going to lose money unless Bitcoin goes down to like below 10,000. And we can get a net, it's priced at NAV, but the stock is priced at NAV on the treasury company, but the converts 30% up. So what I effectively have is, I have it's a 5-year bond with a 3-year put, which means I can give it back to the company and they give me the money back. And I believe they'll have the money because of the collateralization, right? And actually that's the secured collateral. It's oversecured, way oversecured on unsecured collateral. So I believe it. There's no way to lose money really in this. Obviously rates and spreads can trade the par down, but in 3 years, I have an at the money put on Bitcoin by selling a 30% up at the money call for 3 years, plus the ability to get a pop on the valuation premium of this trading from being priced at 1 NAV on the stock to being priced in line with MicroStrategy. So it's the structure is incredible, right? And I can get paid to own it. So there's better risk rewards there. So what I mean by that is there's a lot of overhyped ones that people aren't thoughtful and they're just putting money in for that premium and they don't know a lot about it. But there's really unique ways to structure different risk rewards.
That's incredible. Wow. All right. What is the biggest thing that you've changed your mind about since being in the space for, 10 years, almost 10 years, or more than 10 years now?
Well, very recently, maybe it's crazy to say this. Maybe I'm not, I thought the blockchain, not crypto people were nuts, like open internet. I think there's a room for both, but like back to this whole like traditional businesses using blockchain, I think you're going to see a lot more of that, right? And that will be built on crypto rails, right? But they don't have to all be crypto.
Love that. All right. Is there a piece of content, whether it be a book, blog, podcast, movie, etc., that had a major impact on your life?
Chamath Palihapitiya is the reason I got into crypto. I think because of, obviously my friend got me into it, pushed me over the edge, but Chamath was the first person where I heard talk about it. So, maybe that was what helped me get in. So
very cool. Wow. All right. I this last one's for clickbait, say something crazy here. 10-year price target for Bitcoin. What is it?
I used to think the people who gave these outlandish price targets were crazy before. I need to preface, right? Because if you think about like the value of how much global assets will grow over time, along with the growth of global money supply, right? So a target today that might seem outlandish, even from valuation terms, might not be outlandish in relative valuation terms to the global asset base. So that's what you have to think about it in terms of. So I think, it wouldn't be crazy for Bitcoin to be $1 million. And I'm working back roughly into the math, but like in 10 years, as a percentage of global assets, as a share of global assets, I don't think that's that outlandish. I think, and I'll tell you one for crypto. This is something I've done the math on. Is in Grayscale, I did a report, post-modern portfolio, looking at the long-term capital market assumptions for crypto and based on the internet bubble as a share of global equities. So, right now we're like 1995, which is like 5% share of the global market cap, which is where the internet was as tech. That went to like 25 or 27, right? So global equities today are, 100 plus trillion, over that, right? And, if you compound at 7% for 10 years, what is that number? And then if you were, again, back to 25% today, or even 10%, you can get to a number that's like roughly 20 trillion for the global digital asset market, which sounds crazy relative to 4 where you are currently, but not so crazy in those terms if you follow the internet trend.
Amazing. David, thank you. This has been incredible. Where can people learn more about Finality and connect with yourself?
You can find us on finality.capital, and I'm on Twitter, David_Gride.
Amazing. Thank you, sir.
All right. Thanks a lot.